You know when you're at the airport and you look up at that currency exchange board and it just looks like a jumble of numbers? Well, it's not random at all. It's actually a peek inside the biggest financial market on the planet. And today, we're going to pull back the curtain and make it all make sense. So here's how we're going to break it all down. First up, we'll get right to the basics. What even is an exchange rate? Then we're going to uncover this two-price system that all the brokers use. After that, we'll learn the lingo. You'll know exactly what pips and spreads are. And finally, we'll put it all together and walk through a complete transaction from start to finish. All right, let's dive right in. We've got to start with the absolute basics, the fundamental building block of the entire foreign exchange, or Forex market. So what is it really? Well, at the end of the day, an exchange rate is just a price tag. That's it. It tells you how much of one currency you need to trade to get just one single unit of another currency. It's the core idea that everything else is built on. Okay, so you're never just going to see one currency by itself. They're always quoted in pairs, just like this, EUR/USD. The first one, the euro in this case, that's what we call the base currency. And the second one, the US dollar, is the counter currency. Now, the most important thing to remember here is that the base currency is always the star of the show. It's always equal to 1. So when you see a quote like euro/USD equals 0.84, what does that actually mean? It's simple. It means that 1 euro, our base currency, is worth 0.84 of the counter currency. So 1 euro costs 84 US cents. Easy enough, right? But hold on a second. Is it really that simple? I mean, if you've ever actually swapped cash for a vacation, you probably have a feeling there's a little more to it than that. And that is where we get to section 2. Because for every single currency pair, there isn't just one price. Nope, there are two. Let's see how this works. These two prices are called the bid and the ask. And the easiest way to think about it is from the broker's point of view. The bid price is what they are willing to bid to buy the base currency, our euro, from you. The ask price is what they're asking you to pay when you want to buy that same euro from them. And here is the absolute golden rule of the game. The ask price is always higher than the bid price. It just has to be. Think about it. A broker makes money by buying low and selling high. So they will ask for a higher price when they sell to you, and they will bid a lower price when they buy from you. All right, so this brings up a couple of big questions, right? First, why is there a difference in the first place? And second, what's going on with these tiny numbers that go out 4 decimal places? And this, my friends, leads us right to the heart of how this whole business works. We are about to pull the curtain back on that small difference between those two prices. So that tiny little unit of measurement, it actually has a name. It's called a pip. It stands for percentage in point. You can just forget about trying to talk in fractions of a cent. In the world of Forex, every little price move is measured in pips. It's the standard. So how many pips are sitting between the ask and the bid prices? Well, the calculation gives us something called the spread. And honestly, the math is super simple. All you do is take the higher price, the ask, and subtract the lower price, the bid. And what do you get when you do that subtraction? Boom, 2 pips. That's it. That tiny little difference we saw is exactly 2 pips. And that 2 pip difference is what we call the spread. Now, this isn't just some random gap. This is the broker's fee. It is literally how they get paid for making the trade happen for you. It's their profit, and it's built right into the prices you see. Okay, time for the grand finale. Let's put all these pieces together and walk through a full real-world transaction cycle to see how the bid, the ask, and the spread all come together. This table really lays it all out. Let's follow your money. So say you want to buy the base currency, the euro. Well, the broker is selling it to you, which means you have to pay their higher ask price, okay? Now, later on, you decide you want to sell that euro back. The broker is now buying from you, so they're only going to give you their lower bid price. So you see, whether you're buying or you're selling, you always get the less favorable price. That gap is the spread, and that's the broker's profit. At the end of the day, it all boils down to this one simple idea from our source material. That spread, that little gap between the bid and the ask price, is basically the broker's commission. It's the fee they charge for making the exchange happen for you. So the next time you see an exchange rate, you won't just see one number, you'll see two, and you'll know exactly what that gap between them really means. Which kind of leaves you with one last question to think about. Now that you can see this hidden cost in currencies, what other built-in fees are shaping the financial world all around us?